Hey, this is Chris Franco, and you are listening to Compound Money Quietly, the CMQ Investing podcast. CMQ Investors, welcome to the show. It's great to have you here. This episode is live. There is going to be no edits, no post-production other than, a couple changes, I'm sure, with the volume and things like that. But I'm going to leave all the ums and just generally the parts that I tend to be a perfectionist about. They're all going to stay in. But this episode is about it's about attention-grabbing stocks and really just the role that something being familiar to us can have and how it can cause us to make big mistakes as investors. Now, as those of you who have been following CMQ Investing for a little while now, as you know, something I've wanted to do and I have been doing is collecting the big mistakes that cause investors to just generally lose out on a lot of money long term. And one of the mistakes that pops up in academic study after study is the effect of buying attention-grabbing stocks, or just, if we use a psychology model, familiarity bias. Now, the reason I thought to do this right now and would inspire this right now is we have a CMQ Investing group chat on Signal. We can talk about that later, but one of our very loyal listeners, loyal subscribers, and just a fellow CMQ investor, Dave, I'm just going to call him Dave. Dave had said or had asked me about the QQQ. That's Invesco's. Let me actually pull it up. And this is when I say it's live. You're going to see or hear all the clicking going on. Let me make sure I give you the exact definition. And I, like an idiot, I put the camera kind of in front of the computer screen. So I'm like looking around to try to see what I actually have to say. So the Invesco QQQ Fund is associated with QAnon. And basically what they believe is they've picked stocks that JFK has mentioned in speeches. No, just kidding. It has nothing to do with QAnon. But here's what it says. Access some of today's most innovative companies all in one exchange-traded fund, aka an ETF. Invesco QQQ is an exchange-traded fund that tracks the NASDAQ 100 index. The index includes the 100 largest non-financial companies listed on the NASDAQ based on market cap. So about this, my reason for avoiding the QQQ is the expense ratio. When you add up the expense ratio, and they also have a management fee, it comes out to 0.40%. Now, they're probably, and maybe, I shouldn't say probably, I want to believe there has to be probably a couple other little areas you get charged, but let's just pretend it's 0.4. If we do the math on a 0.4% versus a 0.04%, which is what the Vanguard VTSAX, which tracks the broader stock market, or we could even use the VU, which is 0.03%, well, that makes an enormous difference over the course of your long-term investment time period or your investment lifetime. And that's really what I'm trying to call out here. Now, the second part of this is, why do people even know about the QQQ in the first place? And what this makes me think of is familiarity bias in this pattern that I've observed in, study after study about how we tend to be attracted to attention-grabbing stocks. Now, let me tell you what that is, and I have it from a study here. This is from the abstract of a particular study that I will link to in the newsletter post about this episode. By the way, that is at cmqinvesting.substack.com. It's free to sign up. If you become a paid supporter or a member, there's all sorts of little perks that come with that, but just with your free subscription, you will have a link to this. So it says the following. We test and confirm the hypothesis that individual investors are net buyers of attention-grabbing stocks. That is, stocks in the news, stocks experiencing high abnormal trading volume, and stocks with extreme one-day returns. Attention-driven buying results from the difficulty that investors have searching the thousands of stocks they can potentially buy. Now, this is why I like that we're doing it live, because if we weren't, I would go back and re-record that and then say, it doesn't sound right, and I'd be delayed in getting this information to you. So what I found about this, it reminded me of a big idea or a model from marketing. You could generally call it the consideration set. And that is, a consumer has a total set of potential brands or products that fit a need. Let's say I need a new computer. I might think of Apple, I might think of Dell. I could go down the list here, but for the sake of this conversation, you get the idea. Then there's the awareness set. So the total set is just that doesn't mean I'm aware of it. Awareness set means I'm aware of the brands. Then there's a consideration set, and that's the group that I'm actually going to choose from, or at least that have met the next criteria. Your choice set is when you narrow it down, you can make a decision, and that leads you to your decision. So anyway, it's a little bit, it's kind of probably tough to imagine in your head, but there's a similar process that our brains use when picking stocks. And because there are thousands and thousands of stocks to choose from, and even in the case of mutual funds or ETFs, there's hundreds, I think sometimes thousands of different funds. The consumer has to, meaning us, we have to think of it and narrow it down based on what we're aware of. Now, when I say consumer, that's important to keep in mind because, I was saying in our group chat, the QQQ is a marketable product. I know for myself, in earlier years, I tended to not think of anything that a company was offering as far as, ETFs or mutual funds as a product. I thought it was just like, I don't know, it just didn't strike me as this is a thing that, consumers buy and that has to be, money is spent on marketing and advertising. So when you think of it that way though, we can become, I guess, more conscious consumers. And when we're looking at expense ratios, well, those make an enormous difference over the long term. So we have to really keep an eye out for them. Now, I'm not knocking the QQQ, do your own research, but I personally avoid it because I see better alternatives looking at, let's say, something in Vanguard with a much lower expense ratio. That's just me though. Now, I want to go back on this idea of attention-grabbing stocks because what that reminds me of is familiarity bias. I know I mentioned it, but sure enough, in this one study that I've cited, if not on the podcast before, it's just one that I'm kind of in my top 5 or 10 that I look to I'm narrowing down on our thesis, our mission, our big idea for CMQ about how, by making fewer mistakes than the average investor, we can do better than average over the long term. And considering what we believe about and what we know about rather compound interest and compounding in general, if we can improve the rate of return, our average annualized rate of return, if we can make that, even 1.1% better, or I'm sorry, 0.1 percentage better. I screwed it up again. This is why I don't like doing it live. If we made it 1 percentage point better than the average investor, well, over the duration of your lifetime, let's say through retirement, that's a huge, huge advantage creator. And from my perspective, the best way to do that, as all of us are amateur investors, or most of us are, I'm actually a professional, obviously. No, I'm an amateur as well. But if we go that route, the best way to do 1 percentage point better is to make just less mistakes. You don't have to, as Charlie Munger says, and this is not a perfect quote, but it's, I don't have to do anything brilliant. I just have to avoid stupidity. I have to avoid doing something really dumb. And it's really simple, but it really works. So something dumb that we tend to be drawn to is, buying or picking stocks or funds because we're familiar with them. So familiarity bias, let's talk about that for a second. Okay, I think I have this pulled up. So this one study, which comes from it was published in the Library of Congress. Let me give you the details. Yeah, it was in the Library of Congress. It's titled Behavioral Patterns and Pitfalls of U.S. Investors. This is a report prepared by the Federal Research Division, Library of Congress, under an interagency agreement with the Securities and Exchange Commission. And it was published in August 2010. The researcher was Seth L. Elan, and the project manager was Melinda K. Goodrich. Okay, so going back to this familiarity piece, and bear with me here as I'm keeping this all the way live. They call them glamour stocks, and I'm talking about this without actually having it pulled up here. This is definitely an experiment. I'm like, this will go perfectly. Not. All right, let me find this here. This is ridiculous. Oh, this is great. Okay, familiarity bias. Let me read from this report. People prefer to invest in what is familiar, favoring their own country, region, state, and company. Behavioral finance specialists characterize this preference as familiarity bias. In Familiarity Breeds Investment, Gur Huberman, a professor of behavioral finance at Columbia University's Graduate School of Business, finds that in 49 out of 50 states, investors are more likely to hold shares of their local regional bell operating company than of any other single RBOC. Okay, who gives a damn? No, but we go down a little bit farther here. It says, employers share some of the blame for these patterns, encouraging such behavior, blah, 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 blah. The preference for glamour stocks, and that is high growth, well-known, trendy stocks, is another form of familiarity bias. So I just want to make sure I make that connection. It's not just about, local or, your own company stock. This fits in with these attention grabbing stocks. It's familiarity bias. So then while I was also, trying to answer and research this question, I came across a Wall Street Journal article from 2021, that is this year. It was published or updated, I should say, on March 24th, 2021. And it's titled, Young ETF Buyers Discover the Tech Sector's Old Friend, the QQQ. The mysterious ticker name and branding of the ETF have helped to attract fractional and beginner investors. So could we argue that the QQQ, which is highly marketed, there's a lot of advertising behind it, is that part of the reason that people are attracted to it? Because it's easy to understand, it's a very marketable product, and there's a lot of brand awareness. Let's read what it has to say. And this comes from the Wall Street Journal, and the author is Julia Carpenter. Oh, you might hear some of my dogs are running around. Everything old is new again in the markets, even popular exchange-traded funds. Take QQQ. The giant tech-focused ETF run by investment manager Invesco, launched 22 years ago at the height of the dot-com boom. The fund has in recent months grabbed the attention of a new generation of investors via Reddit's Wall Street Bets and other online investing communities. The fund's concentration in in the high growth stocks billed as innovative and disruptive in the lingo of the day. It tracks the NASDAQ 100 and has made it it's become a favorite of those looking to capitalize on the accelerated shift to working from home. The shares have surged 90% over the past year, and assets in the fund have soared to a recent $150 billion, making it one of the largest ETFs anywhere. Michael Bowers, by the way, I've not read this before, so I just, kind of skimmed it and was like, I want to talk about it. So let's see if there's something that makes me laugh. I have a feeling there will be. Michael Bowers, a 21-year-old Colorado college student, first heard about QQQ on the Reddit forum Wall Street Bets. He bought $1,000 worth of fund shares last summer because the ETF tracks companies he knows and whose products he uses, ranging from Apple to Facebook. Now, I might have to do some post-production and put it like one of those air horns, like, because that's exactly what we're talking about. We're not looking for confirming evidence, by the way. I'm not trying to prove a point. This is just kind of my brain is clicking all this together in real time. Okay, here's a quote from Michael Bowers. When QQQ was rising a lot, it got talked about a decent amount on Reddit, and it led me to look into it. My main love for stocks lies in investor sentiment and hype, basically. I'm invested in reading and seeing what people are talking about, what people are wearing and using, and what will succeed in the future. Okay, warning, that is a horrible idea when things are not just going up like they are for reasons that we won't get into right now, but yeah, that's a bad idea, and that's a mistake I made, as recently as probably 6 years ago. And thankfully I smartened up pretty quickly, but the market wasn't anywhere near as high as it is right now. And I think certain stocks were not I won't say overvalued, because that's a huge broad generalization, but just be really careful about that. Okay, the next, this comes from, this next portion is a quote from Ariat Jain. God, I wish I knew how to say people's names right. Who is a 31-year-old technical sales engineer who owns almost $3,500 in QQQ shares. QQQ is at the top of my list because of the diversity and exposure of its holdings, said Mr. Jain, whose QQQ shares, by the way, that's so ridiculous, this QQQ thing. It sounds like, in Rick Ross Maybach music, that Maybach. It sounds like for QAnon, they'd be like QQQ. All right, just to go with our QAnon theme. Okay, so he says his QQQ shares are his largest ETF investment. He bought the shares when opening his first investing account with Social Finance Incorporated in 2018. And quote, last year we saw the reliance on tech, be it for work or connecting to their loved ones, he said. His interest illustrates how the QQQ has come to embody one of the signature trends of the current market movement. Young investors' embrace of tech investing through online trading, whose falling costs have given rise to tools that didn't exist before. Some of the investors sock away, say, $100 a month for investing purposes, a sum that before the collapse of trading commissions and the rise of fractional share purchases would have put some casual QQQ investments, which has a recent share price of $319 that is, would have put it off limits. Now, SoFi estimates that about 1/4 of its clients' fractional buys are ETFs, with QQQ being one of its most popular. Okay, On Reddit groups like Investing and Stocks, new investors often post asking how much to invest in QQQ, or the Qs as some call it, with others in the comments offering advice and discussing the fund's past performance. The surge in interest among Reddit users and Robinhood traders has presented an opportunity to Invesco, an Atlanta-based investment manager. Invesco has stepped up, here we go, marketing spending to bid in a bid to cash in on QQQ's moment, sponsoring, for instance, a March Madness themed QQQ Hoops game that gives you the opportunity to shoot hoops, showing off the potential performance of investments. Get this, marketing spend for QQQ was $66.8 million in 2020, compared with $19.6 million for State Street's SPDR S&P 500 ETF Trust, which, by the way, that is the original ETF that tracked the S&P 500. I believe it was 1993 or 1994 when that actually came out. Okay, next quote. This is an investor who likes the product because of access to innovation. I can't even read any more of this because this is all just terrible. Not knocking Invesco or anything else, but this is something that I've become much more aware of thanks to John Bogle. I'd say primarily John Bogle because, well, these are marketable products. ETFs, they're great, but the original ETFs were all about passive indexing, broad diversified exposure. QQQ is tracking 100 companies in the top 100 largest companies on the NASDAQ, excluding finance or financial companies. I wouldn't necessarily call that diversified exposure if you compare it to something like the S&P 500 ETF or the entire market index fund like the VTSAX. Now, the reason I bring this up is because, or another reason is when you look at past performance, like I think they said 90%, and this was published I think in March, that 90% return, that's going to attract a lot more dollars. But the problem is, and it's a mistake that's old as the stock market, where investors are using the past performance to extrapolate what will happen in the future, and ultimately, they're buying into something based on a situation that doesn't exist anymore. Like the likelihood of seeing those same returns is well, it's probably not that likely. I think that's the best way to put it. So again, you look at what I said about the awareness and creating like a marketing campaign and spending advertising dollars around these funds. That's what's happening. And what happens with that is that increases the cost, I think you could say operational costs or even the overhead for the fund. And those, that justifies the increase in the expense ratio. Now, some of the Vanguard stuff, like we'll use the VU again as an example, you don't see commercials for that. And as a result, you have I shouldn't say as a result, but one of the reasons that the expense ratio is so low is because it's very affordable for Vanguard to run and they pass on the savings to the customer. That's awesome. And as I said, and we'll say it many more times, the difference of that, the difference of a 0.03% expense ratio and a 0.40% expense ratio, even if they're the exact same fund, or even if they're trading or looking at the exact same, tracking the same index, well, that makes a huge difference. Let me use my little compound interest calculator here and let's see what it would be. I'm gonna pull this up right now. And again, I hope you guys don't mind me fuddling a little bit. I'm doing this, without any delay. There's no script. This is just coming from the heart and soul. So let's imagine an investor has $100,000 every year. They add 10,000. They're going to let it grow for, let's say till 72 in their 30s. So let's say it's 40 years. The interest rate, let's be really modest here, or relatively modest. Let's say it's 6%. Some would say, you could say that's not modest. People would say that's too modest. We're gonna go with 6%. So 6 minus 0.40 is what? 5.40, so 5.4. 5.6. So 5.6, that would be the interest rate if we take out that expense ratio. So our future value is $2 million. Let me say, it's about 2.4 million is the total value in the future. If we take out the initial 100 grand, you're looking at about 2.3 million. 2.3 million unrealized gain. Now, if we do the expense ratio, let me write that down in case I forget or just want to be triple check it. So after everything, 2.3 million rounded off after we take out the initial 100 grand. I didn't take out the 10K edition because I don't want to waste your time. Okay, now let's look at what it would be if the expense ratio was 0.03%. So we take that 6 and we go 5, so it'd be 5.97 is the interest rate. sure I got that right. Okay, that comes out to 2.6. Take 100K out of that, that's 2.5. So you got a difference of about 200 grand over that period of time. Now, that's over a 40-year period, adding 10K at a time. If we were doing, let's say, maybe a bigger starting amount or contributing more, you name it, it's going to keep compounding. So, over 50 years, what would that be? Okay, so 4.862. Now let's go back to the other scenario, which is 5.4? Yeah. Excuse me, 5.6. I did it again. So we're going from 4.862 to 4.211. So, that adds up. Do the math. That money is, just going to basically, costs that you're incurring. Those are paying for the marketing budget and other things. Okay, I feel like I'm moving fast, but it's good. Last thing here, I saw something earlier today about meme stocks, and it makes me think of this because everyone's saying, or not everyone, it's not like Trump, you look what's happening, everybody's talking about it, but you didn't know I could do that. You look at the meme stock situation. So a meme in a lot of ways is like an advertisement. It spreads, it creates awareness, and it creates a viral awareness. That only increases the familiarity bias, it should increase the amount of familiarity, and therefore there's more familiarity bias, there's more awareness, there's more attention, and that can translate into all sorts of these sort of byproducts of that, which therefore, it kind of comes back around and creates this virtuous cycle or vicious cycle, depending on who you ask. So it's funny how we think about familiarity bias, attention grabbing stocks, and the role that memes play in creating attention and familiarity. It's a pretty interesting pattern. So that could be something we explore in more depth. I'm going to leave it here. I'm a little nervous of how this came out just because I've taken so much pride in what I perceive as near the perfection of our podcast. But I hope you get the big idea here. And let me try to recap. It's a bad idea for us as investors, amateur investors, individual investors, retail investors. It's not a good idea to try to pick individual stocks. Passive indexing is, by most studies would say the best approach for the long term. Now, there are other variations of ETFs that are very marketable because they talk about innovation and disruption, and that reminds me of Cathie Wood's various thematic ETFs. But the QQQ is, in that same vein. It's been around longer, but you're seeing it's had a resurgence, or it's become even more popular with this new wave of retail investors for reasons that we could say are, I think we said it. So since that's the case, should you invest? And that was the question that was brought up to me in this signal chat that we have for CMQ Investing. My main reason is no, only because of the expense ratio. But the other reason is, and the reason why people would even be interested is, as we learned, they're spending big time marketing dollars. And as someone who, the most capital I've allocated personally is in the world of marketing and advertising, I know the effect that has. And it's not a terrible thing, especially if you have a product that you believe is good and actually can, add some value to people's lives. But I'm not saying the QQQ doesn't do that, but, next time you start to get excited about a stock, ask yourself, how did I hear about it in the first place? Is it something that, I see a lot of people talking about? Because that could be signs that it might not be the best investment right now. The best investments are oftentimes, if you're talking individual stocks, it's something that the consensus hasn't necessarily agreed to yet. You're seeing something that, the folks, whether it's in a forum, whether it's, on CNBC, whether it's in the Wall Street Journal, not everyone's in congruence, or there's not a consensus on it. You're going against the herd, but you think you really believe you're right, and you have really good reasons for that. But be careful, as always, don't take this as advice. This is just my opinion, my thoughts. I appreciate you tuning in. My name is Chris Franco. This is Compound Money Quietly, the CMQ Investing podcast. Thanks for listening. We'll talk soon. Oh, and don't forget, subscribe on YouTube, CMQ Investing, on Instagram, Charlie Munger Quotes, Warren Buffett videos. You can follow me on Twitter, Chris Franco, Franco with a C. And I think that's it for now. I think that's enough stuff for you to do. Please leave a review, subscribe, whatever you can do to help us continue to reach more investors and just spread good ideas and have good conversations. It means a lot. I appreciate it. I know our community has been growing really healthily, and it's really cool to see. So thank you for being a CMQ investor, and we will talk soon. Later. Hey, this is Chris Franco, and you are listening to Compound Money Quietly, the CMQ Investing Podcast.